Hey everyone, we are live again on That's Our Two Satoshis Live. We do this every Tuesday. We talk about digital assets markets. We write blogs on our website, ar.ca/blog, and then we come on here and talk about it. So let's talk about digital assets. Before we do, quick disclaimer. This commentary is not intended to be investment advice, investment research, or a recommendation. Please consult your investment professional for your own circumstances. For those who don't know me, I'm Jeff Dorman, Chief Investment Officer at ARCA, joined by probably, I guess, the most common guest we have now at this point, Nick Hose. How are you, sir?
Doing good. Hey, everybody.
So we got a lot to talk about today because last week was awesome, right? The equity market up a little bit, kind of flat, gold flat, oil, commodities, up a touch, but digital assets were ripping last week, and it was largely because of the Ethereum Shapella upgrade and fork. Before we start, though, why is it called Shapella now? I've been calling this Shanghai forever. Why is it all of a sudden called Shapella?
So they have some weird stuff where they name it, but essentially it used to be like the application layer and then the layer where you determine consensus had two different upgrades, or they had the same upgrade. And now since proof of stake, they have two different upgrades. And so they combined the names for the two of them, which were Shanghai and Capella.
Got it. The bottom line is this was the completion of proof of stake that Ethereum's been building towards really for multiple years, but I guess you could say from the initial transition, about a year and a half ago, to now mostly completed transition to proof of stake?
2.5 years ago. December 2020, right?
Wow. Okay. Before we get into that, though, before we get and talk about Ethereum, we're going to talk a lot about Ethereum today. But before we do that, let's talk about the macro situation for a little bit. And I know, for those who don't know, Nick comes from a macro background, has a lot of knowledge, puts a lot of great thoughts, both in writing on our blog as well as in tweets, talking about the macro picture. Here's my assessment before I get into yours. Basically, if all you did so far in 2023 was fade consensus, you've done pretty good as an investor this year. Meaning the consensus heading into 2023 was that digital asset investing was dead amidst a regulatory crackdown and a string of high-profile bankruptcies. Obviously, that's not the case. Everyone in the macro world thought higher rates for longer, a drop in stocks, and an imminent recession. We now know recession is probably a little bit off. Stock market's up 8 to 15%, and obviously a huge turn in the expectation for rates around March 7th as the banking crisis began. Consensus heading into March was also that the banking crisis would be bearish for risk assets, including digital assets. And we, of course, know that that's not true. Very bullish, especially for Bitcoin and other bearer assets. Also, I guess, one consensus was that Bitcoin was dead and ETH was going to continue to outperform Bitcoin as it has for the last 3 years. That's not the case. And then, of course, as we get into Ethereum and Shapella upgrade in a second, the consensus heading into Ethereum upgrade was that this was going to be terrible. There's going to be all these unlocks of people who have been staking for the last 2 years, and ETH was going to get crushed. And of course, that didn't happen as well. So what's going on? What is the high-level view from your world on a macro front?
Yeah, definitely within kind of the macro community, the consensus is quite bearish right now. I think people have been gone from focusing really heavily on inflation last year to growth right now. And a lot of people think that growth is going to be like the driver going forward. And certainly, if you look at a lot of leading indicators of growth, things look pretty dire. The counterpoint to that, which I've been doing some work on recently, more is just the liquidity, and that has been such a huge driver of assets recently, especially like in the last 5 years. Liquidity really is just the main driver, rather than these other kind of more fundamental forces that have been so important for macro analysis in the past. And what you've seen is really since September that liquidity has kind of pivoted. You've seen real interest rates come off their highs since that point. You've seen, obviously it's not QE, but bank term funding program like, alphabet soup from the Fed coming out. You've seen just some movements of like just liquidity around the ecosystem or the economy, from like into money market funds, for example, which gives people more access to collateral. And so just generally that, movement of liquidity off the bottom, I think is probably a reasonable explanation for why we've been seeing this improvement recently.
So you're basically saying an increase in global liquidity is effectively masking all the other problems right now?
Not necessarily masking them. I mean, it's liquidity is kind of like the grease of the economy, right? It greases the wheels. So I mean, certainly you see indicators of like, growth and inflation, everything looks like it's going straight down. Liquidity is going to serve to offset that down the line. There's a lagged effect, right? Just like Fed policy, it takes a while to become enacted. And so I guess what the market is saying here is like, okay, we see this big liquidity injection. Is that going to be enough, down the line? Does the recession get pushed off enough where that liquidity injection offsets most of the magnitude of this recession and you just end up getting a soft landing? I mean, if the recession happened today, there's no way, right? But if it gets pushed off 6 months, something like that, then that's really in question.
All right, let me read you some stats about how bearish the market is right now. The S&P 500 E-mini future position data is showing the most bearish reading since November of 2011. The S&P 500 3x inverse ETF, the one that you basically can bet 3 times against the market, saw inflows of 285 million on a single day last week, which was a record. At the same time, the B of A fund manager survey shows that active managers have the lowest exposure to equities relative to bonds since 2009. And that includes May 2020. So basically, not since March of 2009 has the market been this bearish on equities versus bonds. Worth noting, March 2009, of course, was the actual bottom of the market after the 2008 recession and turned out to be basically a 10-year rally after that. And the question, I guess, is why, right? I mean, the VIX is at nearly, yearly lows. You got credit spreads really haven't reacted at all. Even earnings so far, which it's a bit early, but earnings, 10% of the S&P has reported and 90% have beat on earnings while 73% have beat on sales, which is the best upside surprise in the first week of reporting since 2012. So I guess, this is a pretty big tug of war in terms of actual positioning in the market versus what we're seeing today versus what people are expecting in the future.
Yeah. I think it's just like it's a very solid narrative to say we had interest rates increase like the most rapid pace of all time. That's going to cause, go from sucking liquidity out of the system to causing a recession down the line. You have to have that stage 2 credit cycle happen, the credit cycle rollover, in order to reduce this inflation. We've seen some elements of inflation being sticky, and what causes that or what reduces that is really unemployment rising. And you haven't had any signs of that. I mean, even the Fed is saying and unemployment's going to rise. We're projecting a small recession, and so I mean with everybody in the world saying there's going to be a recession, I think it's a relatively easy narrative to follow. But again, on the other side, you've had liquidity kind of offsetting that from a market standpoint.
Yeah, I mean, look, I'm an old man. I remember the late 80s, early 90s as a kid when my parents were cutting back. I remember, 2000, 2001, 2002 when I just started my career in New York. I remember 2008, 2009. During those times, it was bad, right? People were out of work. People did not want to spend money. Airports were empty. Cab lines were empty. Restaurants were empty. You look at today, and this is anecdotal, of course. I got people who are unemployed asking me if I want to go out to fancy dinners. There doesn't seem to be any real contraction of economic activity. Airlines are obviously overcrowded. Trains are overcrowded. Cabs and Ubers are impossible to get. Restaurants are overcrowded. I mean, we may get there, but there are zero signs right now in at least America that this is starting to trickle through yet.
Yeah, I mean, it's certainly that hasn't showed up in the data that you would just like see looking around, right? I mean, even the most leading kind of unemployment data is only just starting to show any signs of weakness, and most of the weakness is coming in the much more credit sensitive sectors like housing, although that's picked up a little bit recently, manufacturing, things like that, where it's more about kind of what it portends for the future rather than looking around and saying, okay, we've got 5% unemployment and the services sector is really taking a hit.
Okay, so with regard to Chappella specifically, talking about how expectations just have been wrong. The expectation heading into last week was that the Shanghai or Chappella upgrade, the 15th hard fork, which was going to activate staked ETH withdrawals and mark the completion of Ethereum's transition to proof of stake. There was a lot of claims that up to 1 million ETH, or basically $2 billion worth of ETH, would be unstaked and sold immediately, and that pretty obvious that market the market was anticipating ETH weakness, right? That's why ETH Bitcoin has traded down so much, meaning the ETH versus Bitcoin pair. It was seemed unfeasible that this was going to happen. But why do you think this was the expectation, and what actually happened?
Yeah, I think this has been a narrative among kind of analysts for quite a while now. And it was always just kind of anticipated by everybody that when withdrawals are enabled, that's bearish for ETH, that, people are going to unlock. They've been locked up for a long time and they'll just want to sell. I think, in the weeks leading up to it, it was pretty apparent that wasn't going to be the case, both due to like the technical mechanisms of how everything works and just due to the lack of interest that we saw in terms of people actually unstaking. And so like just getting into some of those, Kraken was going to be one. We knew that was going to be unstaking because they had to remove all their US customers from staking. We knew that Lido, who accounts for 30% of all the liquid staking, wasn't going to be doing it until May. We know that a lot of these home stakers who account for another 30%, people who spun up validators potentially as early as December 2020 without having any idea when they might get that ETH back. These people are not like, will be gone ETH people who are not going to be like big time holders. They're very much ETH maxis who I don't know why you would anticipate them selling anytime soon if they're willing to do that. So you had this confluence of factors, and then you could see it validated in the actual data that there just wasn't that many people interested in pulling their ETH. Like most of the withdrawals, the like requests for withdrawals that have happened since the upgrade, when you could have just requested beforehand and been guaranteed a spot at the front of the line. So there just wasn't very much interest. You see the queue currently, even it's just maintained the level it's at. So people are kind of just like lazily unstaking in the time since the upgrade happened, rather than having this like rush for the exit like you would have anticipated if you thought there was going to be this mass selling.
Not to mention a lot of misconceptions there, right? So you mentioned Kraken, for example, who from a regulatory perspective had to shut down their staking service. Just because you unstake from Kraken because they have to, doesn't mean you're not going to restake with Coinbase or Lido or Rocket Pool or, on your own. It was a lot of jump to conclusions, if you ask me, with regard to what would happen here. And I think also the other thing we're not talking about is withdrawals. The increase of withdrawals actually also increases the number of deposits, right? I mean, case in point, an upgrade that allows people to exit more safely also gives people more confidence to enter and deposit. I think we're seeing that as well, right? I think as of today, for the first time, there was actually more deposits into ETH staking contracts than there were withdrawals. So I think a lot of analysts and pontificators really miss that aspect as well, which is, think about this for a second. There's really only 4 things to do as an ETH holder, right? One is hold it on exchange as collateral for futures or options or future trades. Those people are still going to hold it on exchanges. Nothing really changes there, right? If you have it on an exchange because you're trying to trade it or you're trying to use it as collateral, you're still going to do it pre and post Chappelle upgrade. 2 is utilize it in DeFi applications. Well, nothing's going to change there, right? I mean, if you have it locked up in a DeFi application like an Aave for borrowing or again, as collateral on one of the DeFi derivatives or even one of the spot exchanges, you're going to keep it there. Maybe you have it a little bit in a wallet just be used for gas, right? Again, that's not going to change. You still need gas. You still need to pay gas even post upgrade. And then number 4, which is hold it passively as an investment. And that's the one that really changed around. Like a lot of people who just hold ETH passively as an investment may not have been willing to stake prior to this Chappelle upgrade because they don't want to lock up their assets for an unknown period of time, right? Those who actually did, right? I think only 15% or so of Ethereum had been staked prior to the upgrade here compared to other proof of stake blockchains, which is closer to 50 or 60%. I think a big reason for that low staking rate is because a lot of people didn't want to stake, not knowing when they were going to be able to get their assets back. But now that you know that you can have instant liquidity on your staked assets, that opens the door for a lot more passive ETH holders to start depositing their assets. I mean, my rule of thumb as a fund manager that I learned over 2 decades plus doing this is you never want to have unproductive assets, right? You always want to put your assets to work. You never want cash in a checking account versus a high rate savings account or a money market. And you don't want your ETH sitting there doing nothing when you can now earn at anywhere from 4 to 5 or 6%, depending on the amount of stakers. So that's a big deal, right? In my opinion, every ETH that is sitting passively in a wallet doing nothing and not meant for gas and not meant for collateral and not meant for trading is going to start getting staked. And I think that increase in deposit rate is going to dwarf any unstaking and withdrawals from this ETH unstaking. So I think we mentioned at the top of the hour a lot of the consensus was wrong thus far this year, and sometimes you think that's because of overcrowding or overpositioning. To me, I think the consensus was just flat out wrong. The analysis was wrong. There was just no chance that this was going to lead to heavy Ethereum selling.
Yeah. I definitely I've come around to that view that there's definitely some more. This definitely adds to incremental demand, and yeah, certainly there. I do think that the staking yield goes up pretty significantly here. I think the biggest question in my mind is kind of whether you get to that moment where it's like staked ETH is treated like liquid ETH, where it's kind of just used as the de facto, medium of exchange. It's like the liquidity pair in decentralized exchanges, or whether that continues to be ETH and you still have this kind of bifurcation where you have ETH liquid and you have some liquid staking tokens liquid, and then you're talking about, more conservative estimate for how much ETH actually gets staked.
Okay.
But certainly up from here.
Yeah. So, we'll see. I mean, ETH is up, roughly 10, 15% or so from pre-Chappelle upgrade. We'll see where it goes from here. Obviously, I think, you can tell the sound that I'm pretty bullish, at least for the foreseeable near future. But what does this mean for the rest of the Ethereum complex, right? I mean, I think we've learned over the last, really 18 months is that the rise in other layer one blockchains, while probably still the future, was really, 2021, mid 2021, late 2021. It was really driven by just how much demand there was for block space and how expensive it was to use Ethereum. And you saw this big rise in everything from Avalanche to Solana to Near to, you name it. All of a sudden, over the last, 12 to 18 months or so, we've really been back into mostly an Ethereum world. And as a result, you've seen the rise of liquid staking derivatives and, most importantly, layer twos. What are you seeing now post this proof of stake completion in terms of the next kind of phase of Ethereum and layer two specifically?
Yeah. I don't think there's a direct effect from the liquid staking on layer twos other than just kind of locking in this Ethereum narrative, which I think is, very helpful. I do think when you have these liquid staking withdrawals enabled and full liquidity for your staked ETH, there's so much more like financialization you can do. For example, when you wanted to stake ETH in the past, you had to take an illiquidity risk, or you had to use like one of these liquid staking protocols. Whereas now you can, you can get it immediately if you want to withdraw. So for example, something we've never had before was like a yield curve on ETH. So you could, one of the easiest ways to financialize this is say, okay, well, you're willing to lock up your ETH for a year instead of, take instant withdrawals. We can give you duration, some extra staking yield for duration risk on that. There's just so many other ways that you can do things with ETH. And I think that's going to be beneficial just for the ETH ecosystem broadly and activity within it. That kind of, as a hybrid, benefits layer twos. These layer twos, you're paying gas in ETH. They're intimately connected to the Ethereum ecosystem. And so just generally, that's going to be really beneficial. And the other thing is that these layer twos have been really good lately, especially compared to where they were back in 2022 or 2021, about really reducing the amount of fees that you have to pay. So now they're much more comparable to where ones were a couple of years back. And there's not that like heavy penalty you pay from staying within the Ethereum ecosystem.
Makes sense. And objectively, at least at the moment, Arbitrum seems to have much larger penetration than any other of the layer twos. Is that correct?
Yeah, for sure.
Okay. We'll see. Ethereum is now a $250 billion asset, and combined, what do you call it, about $25 billion between Arbitrum and Optimism. So you're looking at about 10% of the value of the layer one between the two largest layer twos. That sound cheap, expensive? And again, this is not investment advice. Just curious your thought knowing those numbers.
Yeah. In terms of FDV or fully diluted value, that's the case. It's hard to say. I think that there is a different sort of like market competition at play with these layer twos than I thought in the past. Originally, I thought these layer twos, it was going to kind of be a very competitive marketplace where you could compete on different levels of decentralization, on your community, on culture, on brand, on fees, all these different things. But really, all these layer twos have migrated to a model where they are trying to kind of wrap up all of the different blockchains within their own ecosystem, because there's this benefit of being composable, just like Aave and Uniswap are within Ethereum. Different layer twos within the same ecosystem, the same layer two ecosystem, can be composable in that same way. And I think all of them have recognized this, and that's really going to, over time, cause a kind of a network effect for a couple of layer twos. I think always Ethereum is going to command a very large valuation premium to the layer twos, but is that, is it only that they have 10% of the value? I think that's probably too low. I think the layer twos get a significantly larger market share relative to Ethereum, and that there's going to be, there already is to an extent, but there will remain a pretty big concentration among kind of a couple of layer twos that control most of the market share.
Got it. All right. Well, certainly feels like it's Bitcoin and Ethereum's world right now, and all the things that touch and are generated from Ethereum's success. So be interesting to see what plays out here over the next couple of months, given the bearish positioning overall in the macro environment and the bearish positioning heading into Chappella. It does sort of feel like there's a little bit more meat on the bone here to this recent rally. So we'll see over the next couple of weeks and months if that's true. But for this week, I appreciate everyone listening. Maybe we should call it That's Our 3 Satoshis, given that we dropped quite a bit of information this week. But you can find the actual blog on our website, ar.ca/blog. That's Our 2 Satoshis is the name of the blog. You can find Nick on Twitter at Nick_Hotz. I give him a follow, guys. He has a lot of good insights out there. Talk to him, ask him questions, see what you think about what's going on in the layer 1 and layer 2 blockchain world, as well as the macro landscape. And we will be back again next week. So shout out to the Delray American Little League baseball players. Go Mud Hens. My daughter plays on that team. Go Nationals. My son plays on that team. And we'll keep you updated on that throughout the spring as well. Thanks, everybody. See you next week.